So of course, yesterday we got brand new CPI inflation data out from the US, and for the first time in what feels like years, we had 0% inflation month over month, which was a very nice headline figure, I'm sure you'll all agree. For that year over year figure though, it was a little bit of a less nice 8.5% inflation, which was lower than the prior month's 9.1, and the markets absolutely loved it. Now, investors were expecting a low reading in the first place, but it came in even lower, and so markets and investors in general were absolutely ecstatic. The S&P 500 rose by about 2% yesterday alone, and the Nasdaq was up by almost 3% as well. On the whole, it was a risk-on asset day. Any asset in that sort of area increased in price. Cryptocurrencies were up, as were tech stocks and normal equities too. Ethereum was up by 11% for the day, and Bitcoin was up by 6%, and every altcoin was up too. Today in this video, of course, we're going to explain exactly what the data says. We're going to explain why the markets and investors love this data so much, and why I personally think it's just a little bit too optimistic. Now, what actually is the data? What are the key points that we should be looking at? Well, it's right behind me on this screen here, and you can find all this data really easily if you want, but I'm just going to read out to you the most important figures. So we had year over year CPI inflation of 8.5% and month over month CPI inflation of 0%. For core inflation, which is basically inflation that takes out the volatile food and energy index, we saw year-over-year inflation of 5.9% and 0.3% month over month. For energy prices, we saw them on the whole fall by 4.6% last month. For gasoline, those prices fell by 7.7%, and for fuel oil, that was down 11%. And finally, natural gas prices in the US were down by 3.6%. Now, that was the really strong stuff from this last month's report. That was what actually dragged down the index into this 0% headline figure, and so gas prices basically drove this entire report. As for some other important things though, it was a little bit less good. Food prices actually rose by a massive amount, by 1.1% on the whole. That's 1.3% for food at home, i.e. groceries that you buy from stores like Target, and 0.7% away from home, i.e. prices you pay in restaurants and out and about. Now, this is the specific kind of inflation which is killing lots of consumer-driven businesses like Walmart and Target, because people spend an awful lot of their money on food, far more than they used to, and they have none left over at the end of each paycheck to spend on discretionary products which actually drive profits for a lot of companies like this. Unfortunately, on stuff like this, things aren't really getting better, and inflation is continuing to power along, and this is without a doubt bad news, but it's mostly just being ignored by the markets. As for services, well, they on the whole rose by 0.4% month over month, which isn't great, and house and rent prices under the term shelter rose by 0.5% month over month as well, so also not very good. Now, an interesting thing is that for about an entire year, the federal government and the Federal Reserve has basically been ignoring headline CPI data and instead telling everyone who will listen that we should be looking at core inflation data instead. Now, last month's headline CPI data was really good, while core inflation figures were less so. And so what is the US government doing? Well, they're going back on what they've been preaching over the entirety of the last year and looking almost exclusively at the headline CPI data and ignoring the core inflation numbers. This is pretty shameful stuff, but it really shouldn't surprise you at all from what we've seen with the administration over recent times, with how they're trying to redefine what a recession is and a bunch of other things too. Another big thing that's getting a lot of people's attention is how this current administration is trying to take credit for lower gas prices, despite the fact that gas prices across the US are still far, far higher than they were just a few months ago, and energy prices on the whole are far higher too. Gasoline over the last year has seen 44% inflation. That's including this last month of negative inflation. For fuel oil, that level is 75%. And this isn't good news at all, just because we saw a marginal decrease over 1 month after massive increases over an entire year. Still though, it's not like this CPI report is bad news, is it? It's still better than we were expecting, and it does give the world and the Federal Reserve in particular a little bit of respite, right? Yes, that is true for the most part, and this new narrative that's coming about now is that peak inflation has been and gone, and we're now on the way down, and it's time for us all to throw our money back into the markets because nothing could possibly go wrong. It's time to jump back into cryptocurrency, altcoins, Bitcoin, Ethereum, and Nasdaq hype stocks as well, just like Peloton and Robinhood and the like, right? Well, in my opinion, no, this CPI data was a breath of fresh air, but it's just over only 30 days, and that isn't enough to build any kind of accurate trend. Let's also not forget that just 1 month prior to that, over June, inflation, the headline figure was 1.3%, which is absolutely monstrously high, and July was 0%. And so it's very easy to see if you actually look at the data that the energy price hike in June caused that first really high level of 1.3%, and then the energy price drop in July caused that much lower reading that we just got. But on the whole, energy prices are still far, far higher right now than they were before June. Another problem that I'm seeing a lot of people fall into is that 1 month is just not enough to make a trend. Yes, it is good, and if we get similarly small CPI data prints for the entirety of the rest of this year, then we're probably on track to actually have a good time for the markets, but that hasn't happened yet, and you can't just simply assume it will. The 6-month moving average of core inflation, for example, is still sitting above 0.5%, which is way too damn high. Let's also not forget that just a few months ago, back in March, CPI inflation levels of 8.5% was considered the end of the world and the markets were going to collapse. And now suddenly we're seeing that 8.5% is a good result 6 months later. There's also another problem that we're seeing inflation in more dangerous areas in particular. Now, the big one here to talk about is inflation in shelter or rent and home prices and home ownership costs, which rose by 0.6% over a 6-month moving average. The reason this is so dangerous is because it's very rare that rent prices actually go down because it's quite sticky inflation. Once it goes up, it tends to be really difficult to see it go in the opposite direction. This is the complete opposite to something like energy prices, which can and do move up and down in really drastic swings. Many other forms of inflation don't do that, and that tends to be areas where we're actually seeing quite a lot of inflation these days, which isn't very good either. What exactly are the markets pricing in with this good report then? Why are they so happy, and why did asset prices rise by so much yesterday? Well, there are two main things being priced into the markets right now. The first is all about a soft landing. Now, a soft landing is basically the idea that the Federal Reserve can reduce inflation back to appropriate levels around about 2% while not causing a recession and keeping the economy strong. This is the opposite of a hard landing, which would be where the Fed does manage to reduce inflation, but it comes with an economic crash and a recession. Now, the possibility of a soft landing has been incredibly low over recent months and is very unlikely, and it's also sort of literally impossible, at least in my view, because we're already in a recession with 2 consecutive quarters of negative GDP growth. But the market and many investors have eaten up what the White House is telling them, and they're reiterating this idea that there is no recession and that actually it's all down to the NBER and nothing else really matters. Now, these same people are sat here thinking that the Federal Reserve can get everything right after getting everything wrong for well over a year. This low CPI report, combined with a very strong jobs report over the last month of about 528,000 brand new jobs, makes them optimistic that the economy can remain strong while inflation falls. I, of course, disagree with that idea. Last month's job report being so strong will make higher inflation likely in the future, and also the strong asset prices that we're seeing, this strong performance, is also likely to exacerbate inflation as we go forward too. This month's data was good, but it's only 1 month and it's driven by a sharp drop in energy prices, and it isn't enough to make any kind of long-term trend. Now, the second thing that the markets are pricing in right now is surrounding the Federal Reserve's rate hiking cycle and the idea that actually it might change and the Fed might become more dovish as we move forward. Now, it's no secret, but interest rates have been rising, quantitative tightening has supposedly been starting, and this is bad for markets and asset prices. If inflation continues to drop though, and it gets down towards those 2% levels that we all know and love, well, the Federal Reserve will then of course stop hiking rates, and so this low CPI data should be good news. The market is basically pricing in the possibility that this singular CPI data report will be enough to change the Fed's resolve and to stop them from hiking so aggressively in the future. Now again, this is way too early to make any kind of call like this. The market is expecting tightening to end in early 2023, if not before 2023 all over right now. The Federal Reserve themselves only expect this tightening to end in 2024 or maybe even later, so in my opinion, this is a very dangerous game to play. Right now, though, the market is expecting a 50 basis point rate hike over the next FOMC meeting, as opposed to a 75 basis point rate hike, which is what they were expecting a week ago. I do want to just stress one more thing here before we finish up for the day. I do think people and markets in general are being a little bit too optimistic here. This graph here shows you what year-over-year inflation figures would look like if we see certain levels of month-over-month inflation for every single month until the end of 2022. As you can see, even if we get 0% inflation, not a single rise in prices for the entire rest of the year with 6.3% of inflation, which is 3 times what it really should be and then some. This graph really does just help to sink in how bad of a situation we're in, and this is even with the most optimistic outlooks possible. We are going to be stuck with way too high inflation for at least over a year and almost definitely longer than that. One thing that I did think would be interesting, though, would be to just show you all what exactly Biden has to say about all this.
Before I begin today, I want to say a word about the news that came out today relative to the economy. Actually, I just want to say a number: 0. Today, we received news that our economy had 0% inflation in the month of July. 0%. Here's what that means. While the price of some things went up last month, the price of other things went down by the same amount. The result, 0 inflation last month, but people are still hurting, but 0 inflation last month. Economists look at a measure of inflation that ignores food and energy prices, and they call it core inflation. That's about the lowest amount in several months. When you couple that with last week's booming jobs report of 528,000 jobs created last month and 3.5% unemployment, it underscores the kind of economy we've been building. We're seeing a stronger labor market where jobs are booming and Americans are working, and we're seeing some signs that inflation may be beginning to moderate. That's what happens when you build an economy from the bottom up and the middle out. The wealthy do very well and everyone has a chance.
So that video shows that very clearly. Biden and his administration, they want people to think that the economy is very strong, that it's very good. They're trying to gaslight people into believing that. But the simple truth is, people don't need to be told by their president when they're doing well and when they're rich, because they know innately. 61% of Americans are living paycheck to paycheck right now, and more than ever before have second or third jobs just to make ends meet. Things that clearly aren't as good as Biden and the Democrats want you to think, and someone coming on TV and telling you that things are great when the data says otherwise really is a little bit odd. Finally then, for the end of this video, we had Michael Burry come out from underneath his rock and bless us all with a little bit of wisdom, talking about how the markets have risen for about 6 weeks now. A Nasdaq bull market because it's up 20% off its low. Who makes this stuff up? After 2000, the Nasdaq did that 7 times as it fell 78% to its 2002 low. Along with that is of course this graph showing those 7 individual rallies of 20% that we saw during the dot-com crash. He's of course likening this bear market with that bear market in the early 2000s, and he has a very valid point here in my opinion. The inflation outlook has improved very slightly over the last month, but in what world is 8.5% inflation actually a good level? We are certainly not past the worst of it, at least in my opinion. If you enjoyed this video, then make sure to like, comment and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. Thank you all for watching. Stay stoic. Until next time.